When the economy stumbles, not all housing markets fall equally. Some collapse fast and hard. Across America, certain cities are ticking time bombs of overpricing, investor speculation, and fragile local economies. We're talking median home prices that have surged 50 to 70% in just a few years, mortgage payments swallowing half a household's income, and insurance premiums adding thousands more. If a recession hits, these markets could see values plunge 40 to 60%, erasing hundreds of thousands in equity almost overnight. From flashy boomtowns to overbuilt suburbs, here are the 10 U.S. housing markets most likely to crumble first when the economy goes down. Number 10. Phoenix, Arizona. Phoenix has been riding a housing rocket since 2020, but the same fuel that sent it soaring could turn into a firestorm if the economy tanks. Home prices here climbed a staggering 62% between 2020 and 2023, with the median price hitting around $475,000, a number that's almost double what locals were paying just 5 years ago. The trouble? Wages haven't kept up. The median household income in Phoenix sits near $76,000, meaning a typical buyer now needs to spend more than 40% of their monthly income just to cover a mortgage at current rates hovering around 6.8%. During the boom, investors swarmed in. By some estimates, over 30% of home sales in 2022 involved corporate or out-of-state buyers. That kind of investor-heavy market is volatile. When conditions turn, these buyers don't stick around. They liquidate fast, flooding the market with inventory. Right now, active listings in Phoenix have already climbed over 25% year over year, a red flag for oversupply in a cooling market. Construction is another risk factor. Builders pumped out thousands of new homes to meet pandemic demand, and many of those are still being completed. If sales stall, expect steep discounts. In a crash, price drops of 20 to 30% wouldn't be surprising here. That's $95,000 to $140,000 wiped off a median-priced home. Phoenix's economy is also tied to sectors sensitive to downturns, like tourism, real estate services, and construction, which collectively employ more than 15% of the workforce. In a recession, job losses in these areas could trigger a cascade of foreclosures. Add in rising property taxes, up 12% in some counties since 2021, and insurance premiums jumping due to wildfire risk, and you've got a market already stretched to its limit. If the economy slips, Phoenix could be one of the first dominoes to fall. Number 9. Austin, Texas. Austin was the poster child of the pandemic housing boom, and now it's primed to be a cautionary tale if the economy crashes. Between 2020 and 2022, median home prices exploded by over 65%, peaking around $570,000. Today, even with some softening, affordability is in freefall. The median household income in Austin is roughly $86,000, but at a 6.9% mortgage rate, a typical monthly payment on that median home runs nearly $3,800, well above 30% income-to-housing cost threshold. Austin's market is heavily tied to the tech industry, which employs more than 17% of the workforce. Tech layoffs have already hit major employers, cutting household incomes and weakening buyer demand. The city's unemployment rate remains low, but a recession could easily double it, sending a wave of listings to market. Inventory is swelling fast. Active listings are up nearly 40% year over year, and days on market have tripled from pandemic lows. Builders went all in during the boom, pulling thousands of permits, and now those homes are coming online into a market where demand is fading. In a downturn, developers will slash prices aggressively to offload unsold units. Property taxes in Travis County are another drag, with effective rates around 1.9%. On a $570,000 home, that's nearly $10,800 a year, before adding insurance premiums that have spiked 20 to 30% due to storm risk. If the economy stumbles, Austin's combination of high prices, inflated supply, and industry-specific job risk could easily produce price drops of 25 to 35%. That would erase over $140,000 from median home values, leaving recent buyers deeply underwater. Number 8. Las Vegas, Nevada. Las Vegas is no stranger to housing market meltdowns. In 2008, it became ground zero for the US crash, with prices plunging over 60% in just a few years. Today, the city's setup looks dangerously similar. Median home prices have climbed more than 50% since 2020, now sitting near $440,000, while the median household income is only around $70,000. That means a typical mortgage at 6.8% runs close to $2,900 per month, eating up nearly half of the average household's gross income. The local economy is heavily tied to tourism, hospitality, and gaming, industries that make up about 1 in 4 jobs. When the economy slows, visitors cut spending, casinos see lower revenues, and layoffs ripple through hotels, restaurants, and entertainment venues. During a recession, that translates to rapid job losses and a spike in foreclosures. Investor activity has also been intense. During the boom, corporate buyers and out-of-state investors snapped up large numbers of homes for rentals or flips. In a downturn, these investors often dump properties quickly, creating a flood of inventory. Active listings in Vegas are already up more than 30% year over year, and that number could double if job losses mount. Adding to the risk, construction has been running at full tilt, especially in the suburbs of Henderson and North Las Vegas. New homes are hitting the market at a time when demand is slowing, a dangerous oversupply situation. While property taxes are relatively low at around 0.65%, rising insurance premiums and HOA fees are squeezing owners. Many Vegas homes are also second properties or vacation rentals, which are typically the first to be sold when money gets tight. If the economy contracts, Las Vegas could easily see price declines of 20 to 35%, wiping $88,000 to $154,000 off a median-priced home. A repeat of the city's painful housing history. Number 7. Boise, Idaho. Boise went from a quiet, affordable city to one of America's hottest housing markets almost overnight during the pandemic. Between 2019 and 2022, median home prices skyrocketed over 70%, peaking near $520,000. For context, that's a price tag nearly double the national median, in a city where the median household income is only about $75,000. That means buyers today are staring down monthly mortgage payments of roughly $3,500 at current rates, swallowing well over 50% of the average household's pre-tax earnings. The boom was fueled by an influx of out-of-state buyers, particularly from California, who brought cash and bid far above asking. But in a recession, those migration flows slow, and the local job market, which relies heavily on construction, manufacturing, and small business, can't sustain such inflated prices. Unemployment in Boise is still low, but if it climbs past 6% in a downturn, the housing market could feel an immediate shock. Inventory is already swelling. Active listings are up nearly 45% year over year, and new construction is still underway from the building frenzy of 2021 to 2022. That means a flood of supply could meet falling demand. Property taxes in Ada County have jumped 15 to 20% in recent years, further eroding affordability. Combine that with rising homeowners insurance, up about 25% due to wildfire risk, and many recent buyers are financially stretched thin. If the economy stalls, Boise's home values could tumble 20 to 35%, knocking $100,000 to $180,000 off a median-priced property. For a city that saw one of the fastest price run-ups in the country, the reversal could be just as swift and brutal. Number 6. Tampa, Florida. Tampa's housing market became one of Florida's hottest during the pandemic, with median home prices surging more than 60% between 2020 and 2022, now hovering around $420,000. But the local median household income is roughly $72,000, meaning that at current mortgage rates near 6.9%, a typical monthly payment on a median home is about $2,800, swallowing nearly 47% of the average household's gross income. That's before adding taxes, insurance, and maintenance, which push the real cost of ownership much higher. One of Tampa's biggest threats isn't just high prices. It's the crippling insurance crisis. Home insurance premiums in the region have exploded by 40 to 60% in just 2 years, with many homeowners paying $5,000 to $7,000 annually. Pair that with property taxes averaging around 1%, or $4,200 per year on a median-priced home, and owners can easily face $12,000 plus in yearly carrying costs before utilities or repairs. The market's rapid rise was fueled by a mix of out-of-state migrants, retirees, and investors banking on vacation rentals. But in a downturn, these groups retreat fast. Retirees delay relocation, investors unload properties, and job losses in key sectors like tourism, healthcare, and logistics weaken demand. Inventory is climbing, up more than 35% year over year, and homes are staying on the market far longer than during the 2021 bidding war frenzy. Builders also added thousands of new units during the boom, which are now competing for fewer buyers. If the economy sours, Tampa's housing values could slide 25 to 35%, wiping $105,000 to $147,000 from median prices. For recent buyers stretched to their financial limits, that's a fast path to negative equity. Tampa's surge was built on momentum, migration, and easy money, three pillars that crumble quickly when the economy turns. Number 5. Denver, Colorado. Denver's housing market has been riding high for years, but its price-to-income ratio has reached dangerous territory. Between 2015 and 2022, median home prices surged nearly 80%, with the median now hovering around $600,000. Meanwhile, Denver's median household income sits at about $93,000, creating a serious affordability gap. At a 6.9% mortgage rate, the monthly payment for a median-priced home is close to $4,100, eating up roughly 53% of the average household's gross income. This imbalance has already started to show cracks. Active listings are up nearly 30% year over year, and the average days on market has doubled from its pandemic lows. Much of the city's boom was fueled by tech, finance, and real estate jobs, sectors that tend to feel the sting first in a downturn. If unemployment rises even modestly, forced sales could spike. Another issue is Denver's rapid construction pace. In the past 3 years, builders have been adding thousands of new units, particularly in suburban areas like Aurora and Lakewood. In a recession, that new inventory would collide head-on with shrinking buyer demand. Property taxes are also biting harder. While Colorado's tax rate is modest, assessed values have jumped, meaning annual tax bills for some owners have risen 20% or more. Add in rising insurance premiums due to wildfire and hail risks, and carrying costs are climbing fast. If the economy contracts, Denver's market could see price drops of 20 to 30%, shaving $120,000 to $180,000 off median values. For a city that's long been viewed as a safe bet for housing, the correction could be a harsh wake-up call. Number 4. Salt Lake City, Utah. Salt Lake City's housing market has been on a breakneck climb, with median home prices soaring more than 65% between 2019 and 2022, now hovering near $550,000. That's a massive jump for a city where the median household income is around $87,000, creating one of the largest affordability gaps in the region's history. At current mortgage rates of roughly 6.9%, a buyer purchasing a median-priced home faces monthly payments over $3,700, swallowing about 51% of the average household's gross income. Much of this boom came from a flood of out-of-state buyers, particularly from California, bringing cash or leveraging equity from higher-priced markets. But in a recession, that pipeline dries up fast. The local economy, while growing, is heavily concentrated in sectors vulnerable to downturns: construction, real estate, and a tech industry still in early growth phases. Construction alone makes up nearly 8% of the metro workforce, and if projects stall, job losses will hit hard. Inventory is flashing warning signs. Active listings are up more than 40% year over year, and many homes built during the 2021 to 2022 frenzy are still being completed. That incoming supply risks colliding with shrinking buyer demand, pushing sellers into steep price cuts. Property taxes remain moderate, but higher assessed values are quietly raising bills. Homeowners are also feeling the pinch of rising insurance premiums due to wildfire risk in surrounding counties. Combined with general inflation, higher energy bills, groceries, and transportation costs, household budgets are stretched dangerously thin. If the economy contracts, Salt Lake City could see values drop 25 to 35%, erasing $137,000 to $192,000 from the median home price. For a market that grew faster than almost anywhere else in America, such a reversal wouldn't just be a correction. It would be a shock that redefines the city's housing landscape. Number 3. Miami, Florida. Miami's housing market has been running on overdrive, with median home prices jumping over 55% between 2020 and 2023, now sitting near $560,000. While the skyline gleams with luxury condos and new towers, the local median household income is only about $57,000, one of the lowest among major U.S. metros. That means a median-priced home requires a monthly mortgage payment of roughly $3,800 at current 6.9% rates, swallowing nearly 80% of the average household's gross income. This imbalance is unsustainable, and if the economy falters, Miami could be one of the first luxury-driven markets to crack. The city's housing boom has been fueled by foreign buyers, high-net-worth investors, and a wave of remote workers from New York and California willing to pay cash or inflated prices. But in a recession, these groups retreat quickly. Foreign investment in Miami real estate historically drops sharply during global slowdowns, and wealthy investors have no hesitation dumping properties if profits dry up. Insurance is a ticking time bomb. South Florida's home insurance premiums have surged 50 to 70% in just 3 years, with many Miami homeowners now paying $8,000 to $12,000 annually. Property taxes on a median-priced home can easily exceed $9,000, creating annual carrying costs of $20,000 plus before even touching maintenance or HOA fees. Tourism, finance, and trade, Miami's economic pillars, are all sensitive to downturns. If job losses spread, especially in service and hospitality sectors, mortgage defaults could spike. Meanwhile, condo inventory is climbing as pre-construction units from the boom years hit the market. Many of these are investor-owned and will be the first to be sold in a downturn. If the economy contracts, Miami could see price drops of 30 to 40%, erasing $170,000 to $224,000 from median values. For recent buyers stretched to the limit, that could mean being underwater within a year. Miami's glittering facade hides a housing market that's dangerously leveraged on wealth and speculation, a dangerous combination when the tide turns. Number 2. Sacramento, California. Sacramento became one of California's hottest housing markets during the pandemic, with prices soaring more than 50% from 2019 to 2022 as remote workers from the Bay Area poured in. The median home price now sits around $510,000, while the median household income is about $84,000. At a 6.9% mortgage rate, that means a monthly payment of nearly $3,500, consuming over 50% of the average household's gross income, well above the traditional affordability threshold. Sacramento's boom relied heavily on migration from higher-cost cities like San Francisco and San Jose. But that migration wave is slowing as tech layoffs rise and remote work benefits are reduced. Without that inflow of wealthier buyers, local demand alone can't sustain such inflated prices. Inventory is up over 35% year over year, and days on market have doubled since 2021. Builders added thousands of homes in surrounding suburbs like Elk Grove, Roseville, and Folsom during the boom, and those units are still being delivered into a cooling market. Property taxes average about 1%, but on a $510,000 home, that's still more than $5,000 annually. Combine that with rising insurance premiums from wildfire risk and higher utility costs, and many homeowners are feeling the pinch. Sacramento's economy is tied to state government jobs, healthcare, and education, sectors that may see hiring freezes or cuts in a recession. While these jobs are more stable than tech, they're not immune to budget shortfalls. In a downturn, Sacramento could face price declines of 25 to 35%, wiping $127,000 to $178,000 from median home values. For a market that sold itself as the affordable alternative to the Bay Area, a sharp correction could leave thousands of recent buyers with negative equity and a tough choice: hold on and bleed cash, or walk away. Number 1. San Francisco Bay Area, California. The San Francisco Bay Area has always been one of the most expensive housing markets in the world, but that also makes it one of the most fragile when the economy turns. The median home price across the region still hovers near a staggering $1.25 million, with core cities like San Francisco and Palo Alto easily topping $1.8 to $2.5 million. With mortgage rates around 6.9%, a median-priced home comes with a monthly payment of roughly $8,200 before taxes and insurance. For the average Bay Area household earning about $136,000, that's over 72% of gross income, far beyond sustainable levels. The boom was fueled by high-paying tech jobs, IPO windfalls, and an endless stream of global capital chasing trophy properties. But those same factors turn into liabilities in a recession. Tech layoffs have already hit major employers, with thousands of jobs cut at companies like Meta, Google, and Salesforce. Many of those laid-off workers were also homeowners with large mortgages and limited liquidity, making them vulnerable to forced sales. Inventory is slowly climbing, up nearly 25% year over year, and many luxury properties are sitting on the market for months, something unheard of during the pandemic frenzy. Sellers are already making price cuts averaging 8 to 12% on high-end homes to attract buyers. Carrying costs are punishing. Property taxes average around 1.1%, meaning $13,750 annually on a $1.25 million home, while insurance can easily top $4,000 to $6,000, even higher in wildfire-prone counties. For luxury properties, those numbers double or triple. Add in HOA fees for condos, which often exceed $1,000 per month, and total ownership costs can approach $120,000 annually. The Bay Area's reliance on volatile equity markets is another Achilles heel. When stock values fall, so does down payment cash, especially for buyers in the $2 to $5 million range. That ripples downward into mid-tier markets. In a major downturn, prices could fall 30 to 40%. Erasing $375,000 to $500,000 from a median-priced home, and over $1 million on ultra-luxury properties. For a region that's defined by wealth and tech-fueled growth, such a collapse wouldn't just be an economic event. It would be a cultural shockwave, rewriting the Bay Area's housing narrative for years to come.